Hey, it's Jack. Tuesday morning. The market's acting kind of funny today in the sense that, as I told you yesterday, we got the CPI and the PPI coming out Wednesday and Thursday tomorrow, but the market's kind of creeping higher in the face of this. And what this is kind of saying is, right now, all three indexes are bullish, especially QQQ. And a lot of these stocks are just shrugging off what could be possibly bad news. And that is a very bullish sign for the market. But what's even more bullish is the way institutions and individual investors are going after options on certain stocks rather than buying the stock. So I get the question a lot is, what stocks have the best options? And that means different things for different people. The best options for buying to see them skyrocket in price, or the best options for selling to create income. Both are good. I like the income side better. The odds are about 1,000 times better on the sell side. But here's the answer to the question of which stocks have the best options. Is first of all, a stock has to have two things going for it to have good options. It has to have some volatility, a little more volatility than the broad market, and it has to have a directional bias. In other words, a trend. Now let's talk about that volatility. What is it? How do you know if it's a volatile stock? Well, there's a measurement called beta. And what beta is it tells you how much does an individual stock move relative to the broad market. So the S&P 500, the broad market, it has a beta of 1. Now, when you look at an individual stock quote, you might see beta on there. Even Yahoo Finance tells you the beta of a stock. And if it's below 1, the stock is not volatile. It's not even as volatile as the broad market. If the beta is over 1, then the stock is a little bit more volatile than the broad market. So if it's a beta of 2, it's twice as volatile as the broad market. So those stocks that have a beta over 1 and have a directional bias have really great options. And one way you can tell is simply take the value, the strike price value of a call option 30 to 40 days out and divide it by the stock price, and you'll see the yield you would get on that as a covered call. But that's also going to tell you how valuable that option is relative to the stock or other options. So take a look right now, like Meta, great options. Apple, great. Nvidia, awesome. That's where it's at. It's still in the tech. Tesla, even, great. Got a beta of probably 2, over, twice as much as the broad market. So that's where the action's at right now. And stay tuned, because I got a really big, after I finish this breakfast cigar, I'm going to send you another email. You're going to love it. Pay attention.